Not there yet. In the war in Ukraine, in recovering from an environmental disaster in Ohio, in coming to terms with social media, or in taming inflation. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers of Harvard on whether the Fed has the tools it needs to deal with inflation.
We've got an extremely difficult economy to read.
Former National Security Advisor Tom Donilon on how the war in Ukraine has changed investment behavior.
Any analysis, right, with respect to investing has to take into account now geopolitics in ways that you might not have before.
And Bob Diamond of Atlas Merchant Capital on the future of digital payments after FTX. This week, it wasn't so much about what's been finished as it was about what's yet to be finished, starting with the war in Ukraine, 1 year old as of this Friday, which took President Biden to the region.
We'll hold accountable those who are responsible for this war, and we'll seek justice for the war crimes and crimes against humanity continuing to be committed by the Russians.
With Russian President Putin providing his alternative view of events.
They are to blame for unleashing the war, and we are doing our best, our utmost, to stop the war.
It wasn't a war that took Transportation Secretary Pete Buttigieg and former President Donald Trump to Ohio, but an environmental disaster from a train derailment that spilled toxic chemicals through the small community of East Palestine, with the cleanup far from finished.
A long way to go, before we're at the finish line. It will be months and years before the residents of that community are going to feel safe in their homes and in their community.
At the Supreme Court, there were 2 days of oral arguments trying to sort out just when, if ever, social media companies might be held responsible for terrible acts, arguably encouraged by videos and tweets posted on their sites, with Justice Elena Kagan summing up how difficult it is for the Supreme Court to draw lines around the internet.
I mean, we're a court. We really don't know about these things. These are not like the 9 greatest experts on the internet.
And then there was the Federal Reserve, which released the minutes from its January meeting, which markets had been eagerly anticipating, but in the end didn't really change much the path we thought the Fed was on.
The minutes say the participants agreed the risks were still to the downside for economic activity. They worried about an unexpected negative shock that could, quote, tip the economy into recession in an environment of subdued growth.
But then on Friday, core PCE numbers came in hotter than expected, delivering a clearer message to the markets that rates are likely to be higher for longer, leaving the S&P 500 down almost 2.7% for the week, while the NASDAQ lost 3.3%. And what equities lost, bond yields gained, with the yield on the 10-year up 12 basis points to end the week at 3.94. To explain it all to us, we welcome now Greg Peters. He's PGIM co-CIO for fixed income, and Liz Ann Saunders, Charles Schwab, Chief Investment Strategist. Welcome back, both of you. Good to have you here. So, Liz Ann, let me start with you. Are the markets starting to come to terms with what's likely to come? And if so, what is likely to come?
So, yeah, I do think that the stock market is going through a bit of a reset. There's the old phrase actually coined by my first boss in this business, the late, great Marty Zweig, who was part of the original Wall Street Week for many, many years. And he coined the phrase, don't fight the Fed. And I've been getting a lot of questions. Do you think stock market's been fighting the Fed? I think the stock market's been fighting the bond market. And the messages from the bond market, I think, have been telling a more accurate story. And there was a disconnect there for a while, certainly a big part of the rally in January. Now I think the equity market is coming to terms with the fact that the job is not done for the Fed. They probably have to hike at least maybe once or twice more than what was even built into expectations a week ago, because the inflation data continues to be I think, too high for the Fed's comfort zone. And now I think the market, the equity market, is adjusting not only its expectations, but some of the embedded leadership trends that I think were sending a different message in January.
Greg, do the different indicators in the market really agree with one another? Are they pointing in the same direction? Because you have things like, at least until recently, really pricing in price cuts, rate cuts across the board. At the same time, we've got a very tight labor market. We've got a really inverted yield curve. Where does this all add up to?
Yeah, so it has to be reconciled, David. And so I agree with Lizanne. The equity market is fighting the bond market. The bond market is telling you, with the inversion in the curve, and it just priced out the cuts, but it's still telling you that rough roads are ahead in terms of the economy is concerned. Yet risk markets have been flying up until recently. And so I think what 2023 is really going to be about is reconciling those two markets. So you can't have an inverted yield curve that's predictive of a recession and equities and risk markets rallying as hard as they've been. So I think it's just the start of it, to be honest with you.
Well, listen, I wonder about that reconciliation, where it's going to end up, because there are a lot of indicators in the economy that say it's pretty strong still. There's a lot of growth, particularly consumer sentiment, a lot of consumer buying still going on. Certainly we have a tight labor market. At the same time, we keep adding employees, but the productivity is not going up.
Yeah, and I think that's what's embedded in this odd mix of some measures showing pretty weak economic data, particularly fourth quarter, not GDP, but the real final sales on the domestic side. That's kind of a cleaner way of looking at the economy that takes out the inventory effects as well as some of the trade effects. And that was barely in positive territory, yet you had this, boom in job creation in January. I think there may have been some seasonal adjustments that kind of wreaked havoc with that number and may help to explain why there is that disconnect. But, what we've been talking about is the rolling nature of how this cycle is unfolding, not just in terms of the economy. We've been calling it a rolling recession, where there are pockets of the economy, certainly housing, many of the consumer goods oriented segments of the economy that were big beneficiaries of the lockdown phase. Those are in recession territory. That's where we have been seeing not just disinflation, but outright deflation. But we've had the offsetting more recent strength on the services side. Services is a larger employer. That's helped to explain why the job market has been relatively healthy. The real problem right now is that we still have the sticky services inflation on the high side, but we're starting to lose the offset of deflation on some of the goods categories. You saw a tick back up in used car prices. I think, retailers have worked off a lot of the inventory that was sort of extreme in its excess even just a few months ago. And so what we may see happening is, even if we start to see some retreat on the services side, we're getting a little bit of an uncomfortable lift again within the inflation data on the goods side. Not exactly what any of us, and certainly the Fed, wants to see.
So, Greg, pick up on that, specifically the inflation data, because one of the issues is the so-called super core, that, as I understand it, is the core inflation less taking out the housing issue. And that seems to not be going in a favorable way for the Fed. What does that tell the Fed? 50 basis points next time, or just do 25 more often?
Well, the Fed is kind of stuck here over the near term. The markets now have changed pricing pretty radically, where now, after today, it's a 50% chance of a 50 basis point hike in March. Up until recently, it was barely 25. And there were many market players who were suggesting that they're already done, and maybe the last 25. So the inflation data has not really moved in their favor. But the services is tied to the labor market. And I think the trick that we have in terms of shaking out inflation in this economy is that it's really hard to shake out services inflation when you have such strong labor markets. And so we're at a record unemployment rate. And so I think the Fed believes now that in order to get inflation under control, they have to do more in terms of weakening the labor market.
Thanks so much to Lizanne Saunders and Greg Peters. They were going to be staying with us as we turn to what a full year of war in Ukraine means for investors. That's next on Wall Street Week on Bloomberg.
Actually, the market did cheer for Carter for about 1 hour Monday morning. Then arrived the first of several indications that when it came to the details of a comprehensive Mideast agreement, Menachem Begin and Anwar Sadat might just possibly have been attending two different summits. Investors got the jitters about the possibility that it might all come unglued, and that provided a perfect excuse to resume worrying about less cosmic matters, like whether an ambitious young investor could really find wealth and happiness with the prime rate approaching 10%. Oh, fragile bird of peace, where have you flown?
That was Louis Rukeyser on Wall Street Week back in September of 1978, when then President Carter was working on what seemed to be miracles in the Middle East, and the markets just seemed to be shrugging it all off. The #1 movie that week was Animal House with John Belushi, and the #1 song was, believe it or not, Boogie Oogie Oogie by A Taste of Honey, which I'm not going to try to sing. Still with us are Liz Ann Saunders of Charles Schwab and Greg Peters of PGIM. So, Greg, I won't ask you to sing it either, but give us a sense from an investor's point of view, a bond investor in particular, given what you and Liz Ann have been talking about in the markets, what does a bond investor do right now?
I think they sit and wait. We've had a pretty big move in risk assets. I still believe there's some repricing in the bond market. If you look at the shape of the curve, it has to be reconciled within the bond market too. So if we do hit a soft landing, then the inverted yield curve can't be at its extreme level that we see today. And then vice versa, if we enter a recession, then it's more reaffirmed. But I think the pressure for yields over the near term is higher, not lower. At the same time, though, once yields get above 4%, all else equal, we get a lot more excited around investing in the sovereign bond market here in the U.S.
So, Lizander, what about a stock picker? What should they do?
Well, one of the things we were saying during the sort of heart, or maybe I should say heat of the January rally, was to fade the low quality, high beta, non-profitable, heavily shorted trades that had kicked back in and lean more into quality factors. I think when you take a factor-based approach, essentially investing based on characteristics, one of the things investors should do is focus on factors that represent things that are dear from a macro perspective. So we're in a declining earnings revision, declining forward earnings estimate environment. So look for companies with positive earnings revisions, positive earnings surprises. We're obviously in a rising interest rate environment. Look for strength of balance sheet with high cash levels, low debt, companies with pricing power in a more constrained demand environment. So kind of lean into up quality and fade the down quality that I think was disconnected from the fundamentals at a more macro level. And we have already started to see a reversal there.
Lizanne, I'm mindful of the fact that this week marks the end of the first year of Russia's war in Ukraine. And I wonder, looking back on this year and looking forward as well, what effect, if any, Lizanne, do you think that this conflict, this war in Ukraine has had on investors?
So it's not having the day-to-day, intraday volatility impact as it did in the first month or two of the war, but clearly the effect is still there, both up and down through the commodity channels. I think also more recently, it's maybe either highlighting or speeding up what I think is a secular theme that was happening anyway, which is not really deglobalization, but regionalizations, economic, geopolitical factions and segments of the world kind of banding together. And as we see with some deterioration in our relationship with China and what China's trying to do with regard to Russia, I think it's maybe putting a spotlight on some of those alliances that are forming, that are happening for reasons other than just the war.
Greg, what about from your point of view for fixed income? Are we seeing a different regime going forward for investors?
I think we are. I think we've already entered the new regime where central banks are no longer at investors' beck and call. They're fighting a different problem. That's inflation. I also think geopolitical risk is a new secular theme. This is just one avenue, just one part of the puzzle around geopolitics. And I think that has to be embedded in risk premium. So I look at the market today versus a year ago, a year and a half ago, and I think it's a very different place. And the geopolitical landscape is very different. And investors have been paid to ignore it for years and years and years, and I don't think that's the case going forward.
Listen, one last one to you from your point of view. Are we looking at a new world of higher prices, and not just because of energy and the disruption of energy because of Ukraine, but also some of the disruption or change, at least in globalization, in labor markets?
I think we're in a now secular environment of more volatility in inflation, in commodity prices, in geopolitics. And I think that, the era of the great moderation, I think, is definitively over. That was the era of abundant access to cheap goods, cheap energy, cheap labor, and that those ships have sailed. And in particular, demographics, I think, is reshaping this next secular phase here. And it's just not going to look like the 20 years pre-pandemic.
Do you agree with that, Greg?
I do indeed. That's just one of the many secular shifts. So I definitely agree with that thematic.
Okay, thank you both very much for being back with us. Next time, I promise we'll do Boogie Oogie Oogie together. Many thanks to Liz Ann Saunders of Charles Schwab and Greg Peters of PGIM. Coming up, we're going to talk with Bob Diamond of Atlas Merchant Capital about what the crypto scandals have meant for digital payments and blockchain. That's coming up next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. The promise of digital transformation of finance has excited investors for years now, with particular attention given recently to blockchain technology, cryptocurrencies, and yes, the prospects of regulation. Bob Diamond's Atlas Merchant Capital has been an early adopter and investor, and we welcome him back now to Wall Street Week. Great to have you here, Bob. Thank you for joining us. Bring us up to speed on where we are, on blockchain, on digital finance, where we are, because there have been some bumps along the road. I mean, there have been some scandals along the road. Some people have lost some money. Is it slowing things down?
Not really. I mean, I think in many ways, FTX and many of the other issues that we've had to deal with over the last year have definitely had an impact. Crypto is a very broad term, but I think of the space really as more around technology. There's no doubt in my mind that we're going to have a digital version of the US dollar. It just makes sense. There's no doubt in my mind that blockchain technology will continue to be implemented in most of the big financial institutions. It makes things faster. It makes them cheaper. And in this day and age, having a digital version of the US dollar or most major fiat currencies just makes total sense.
As an investor in these, I'm curious, how much of that is consumer-facing and how much of that is, as it were, in the plumbing? Yeah. You can have the banks use the blockchain for their transactions and things. You have the Fed do that. That's different from selling it to the public.
Well, as you know, we've been an early investor in Circle, which is U.S. digital coin. And that's very much business to business. It's about the large institutional payments, which traditionally have gone from bank to bank, and you and I have waited 2 or 3 days to have those types of transactions take place. With blockchain, with the internet, with digital currency, using USDC, these things can be done anytime, 24/7, instantaneously, and without an intermediary. And I think the dramatic impact this will have on kind of the treasury functions of corporates and financial institutions around the world over the next 5 to 10 years will be significant. And I think, to me, the positive of everything that went on with FTX, for example, is that people now understand the difference between offshore and onshore. And Circle, which again is U.S. digital coin, operates within the U.S. regulatory perimeter. Really embraces regulation. Any sound business wants sound regulation, is very transparent about what the portfolio is backing the USDC, which is cash and short-term treasury bills, where a dollar is a dollar is a dollar. And I think, David, at the end of the day, is it best for our government, for the Federal Reserve, to be developing the digital currency, or the private sector, people like Circle, to develop it and then have it properly regulated? And I think that's the way most technical innovations, whether it's the FedWire or the SWIFT payment system, have come about.
So from your perspective, which is a terribly valuable one, is it best to leave the regulation right where it is right now because it works basically for people like you and your companies, it works fine? Or are there things that could be regulated that would actually help you, that would buttress your business? Or is there some other way of doing this? What do you think is the right way to go for the U.S. government?
So I think there's a couple of buckets here. I think number one, operating onshore within the U.S. regulatory perimeter is critical. And I think that was writ large during FTX when people realized what was going on in the Bahamas outside of the U.S. regulatory perimeter. Since then, the market share of USDC, which is within that perimeter, has dramatically improved relative to Tether, which is offshore, somewhat murky in terms of what's in that portfolio. So we're seeing the impact already. The next step in this is who is the regulator. So right now, the states are regulating payments, and will it be the Fed, will it be the SEC, and what's the next step for the federal government in terms of assigning regulatory responsibility? We embrace getting those decisions made in going forward with frankly, a more transparent, more regulated environment. Proper regulation, good regulation, strong regulation is what good, strong companies want, and I think it will help us get to the next step in digital currencies.
There's a central bank digital currency, and by that I mean the Fed for this purpose, because China we know is developing one,
Yep.
Europe is developing one, but a central bank digital currency for the Fed, is that important? Is it valuable? Why do they need to be in that business?
I don't think they do, and I think we believe that USDC can operate alongside a central bank digital currency or without a central bank digital currency. We think it's much more typical of China, where the government would do the technology and do the developments, and it's much more typical of the U.S. economic system, where the private sector develops the technology. That's where the real innovation is, and it's up to our regulators, the Fed in this case, to provide effective, strong regulation.
Do we need legislation?
I'm sure we do over time. We need to resolve who's regulating what pieces of technology here.
Do we need to be concerned about a competition internationally? I mean, as I said, China is developing a central bank digital currency. A lot of people question that about whether people are going to trust that because of the nature of the government. But Europe also is. Do we need to be worried about being behind some other countries?
I think it's important for the U.S. to be a leader here. I don't think they're falling behind at all. And I think some of the developments we've talked about in terms of USDC are very competitive right now.
So what's next for your operation, USDC? What's the next mountain to climb?
Well, I think what we're seeing is everything we're investing in has some form of tech-enabled structure. And I think with some of the values in tech coming down over the last year or so, what people have not realized is that almost every investment in financial services has tech enabling with it. It's the insurtech space. You know, the insurance companies are really developing a lot of technology. When we invested in Marshberry, it has a tech enablement. When we invested in DPL, it has tech enablement. So I think what's happening in tech is just a critical part of everything that we're investing in.
So let me try to take a bridge too far, if I could. AI and ChatGPT or chatbots. Is there a role for that? We saw actually Goldman this week say, let's stay away from that.
This is, I think we're at the very early stages. I will tell you, my alma mater, my beloved Colby College, through a terrific grant from the Davis family, has a major. This is a liberal arts school in Maine, and they have a major in artificial intelligence that began about a year ago. We have to realize how important this is, but I think it's just an indication of how early in the stage and how important this is. As an investor, this is an area that's very, very, very interesting.
Is that interesting?
Absolutely.
You're interested in investing in AI right now.
Oh, absolutely.
That's fascinating. Thank you so much, Bob. It's always great to have you here on Wall Street Week. That's Bob Diamond. He is the founder and CEO of Atlas Merchant Capital, who is very invested, as you can tell, in digital finance. Coming up, 1 year after the Russian invasion of Ukraine, what has the conflict meant for economies, markets, and investors? We'll ask the National Security Advisor to President Barack Obama, Tom Donilon. That's next on Wall Street Week on Bloomberg. A ground war in Europe. Friday marks 1 year since Russia invaded Ukraine.
1 year ago, the world was bracing for the fall of Kyiv. Well, I just come from a visit to Kyiv, and I can report Kyiv stands strong.
despite all the predictions to the contrary.
After 12 days, it's already clear that Putin has made a miscalculation. He has underestimated the Ukrainians, their heroic resistance. He's underestimated their leader. And he has underestimated the unity of the West.
And predictions that, if it happened, it wouldn't last long.
I see no tendency in war dragging on for 2, 3, 4 years if Ukraine keeps getting weapons on time.
The war has cost thousands of lives, Ukrainian and Russian, displaced millions of civilians, and done untold damage to the Ukrainian economy.
8 months into Russia's own provoked, unjustified war against Ukraine, the deaths, displacements, and destruction continue.
But it's also had profound effects on the global economy and on investors around the world. As the price of oil spiked and remains elevated,
gas prices will remain very high, and it also may result in some disruption.
And its effects on the global food supply chain, and grain in particular, are still being felt.
We're calling on all countries to refrain from banning food exports or hoarding grain while so many people are suffering.
While Western sanctions against Russia have upended trade and financial relations around the world.
Russia's economy is in a great deal of pain because of the sanctions that we've implemented with 30 other countries, and the pain is going to continue for years to come.
All of which raises questions about what comes next and whether there can ever be a return to normal. And to give us a sense of what the shift in geopolitics has meant for investors and business around the world, not just for the last year with Ukraine, but over the next several years, we turn to somebody who knows geopolitics like no one else. He's Tom Donilon. He served, of course, as National Security Advisor to President Obama. So, Tom, thank you so much for being with us. First of all, give us a sense. What do you think has been shifted more or less permanently in geopolitics because of this Russian invasion?
Yeah, thank you, David. It's good to be with you. And I think there have been some changes which are durable. And thanks for the opportunity to kind of to step back here and consider what the changes are. Of course, the Russian invasion of Ukraine was the most important security event in Europe since World War II. But beyond it being a regional security event, David, as you alluded to, it has had durable and global impact. And I see that first in geopolitics. We can talk about energy and deglobalization and things like that. But if you start with just the geopolitics, I'd say this. It has exacerbated, it has propelled, it's accelerated fragmentation among the important countries in the world, the important regions in the world. And it's caused, I think, the emergence of geopolitical and economic blocs in the world, which are competing with one another. And you can see that if you try to just think about a map of the world, right? The first block, if you think about three or four blocks, is the West, the United States, the G7, which have come together in a very cohesive way to support the effort in Ukraine against the Russian invasion. Indeed, I think the numbers now are that the West has provided Ukraine with around 145 billion euros of support, led principally by the United States. And that, of course, has resulted in a real division between the West and Russia, which I think is a durable and for all intents and purposes, for a semi-permanent division between the West and Russia. I think over the long term, no matter how long it takes for the war in Ukraine to come to some sort of stable place or settlement, which I think is a long-term event, right? I think you'll see a fundamental division down the middle of Europe between Russia and the West across multiple dimensions: military, political, cultural, economic, right, ideological, and I think that's for the long term. I think that's a fundamental impact, if you will, of Russia separating from the West over its invasion of Ukraine. The second, I think, dynamic is the coming together in what I think is an increasingly durable partnership between Russia and China. You see it in terms of their alignment strategically against the United States. You see it in the increased economic relationship that they have, where the relationship has really developed quite substantially. Beginning in 2014, but really accelerated with the Russian invasion. You see it across all kinds of dimensions, by the way. You see it in the energy dimension, you see it in the goods dimension, you see it in the technology dimension. And that's a fundamental change. As I said, I think they're strategically aligned in terms of their opposition to the United States and the West. And I think that Putin and Xi Jinping have a personal relationship, which has driven this as well. There's one here to watch, because this really has, in addition to driving a split with Russia, which is obvious, it's also been driving and exacerbating tensions with China between the United States, Europe, the West on one hand, and China on the other hand, over China's support for Russia. One thing to watch, I think, for investors and those studying the geopolitics of this is this issue which has arisen over the last couple of days, raised quite directly by Secretary of State Tony Blinken, as to whether or not China is supplying lethal military assistance to Russia. If that comes to be established as a fact, that's a major event. That's a market-moving event, because the United States and the West will react quite dramatically, I think, to that. So you've got Europe, Russia, China, and the last is a large group of countries in the world. In the Cold War, we would have called them the kind of unaligned movement, the global South. I prefer them now as multi-aligned countries, and they're the countries over which there's a lot of competition between Russia and China on the one hand, and the United States and the West on the other hand. So bottom line, I think, if we can go on to other topics, is that there has been a dramatic acceleration, I think, and deepening of fragmentation in the world, which, I'll finish up on this, has really adversely affected international cooperation. If you think back to 2009 with the great financial crisis in London at the G20 meeting, where I worked with President Obama, you had the Russian Federation, China, and the United States sitting down at the same table, trying to develop an approach to the global financial crisis, trying to bring the world back from the abyss. You couldn't ever imagine, David, that meeting taking place today.
So, Tom, listening to all that, it's fascinating and comprehensive. As an investor, what I hear is risk and geopolitical risk in particular creeping in to really reduce a lot of my returns. Is it all risk, or is there also opportunity, do you see?
All this opportunity, I think, but it is important, I think, to understand that geopolitics, in ways that wasn't the case, right? I think wasn't the case really before the dynamics really were driven by COVID, by the Russian invasion, by these repeated shocks to the system, but especially the Russian invasion of Ukraine. I do think that any analysis, right, with respect to investing, has to take into account now geopolitics in ways that you might not have before. Energy is a good example of that, David, right? You know, where if you look at the energy situation right now, geopolitics has really kind of come back to the fore with respect to energy dynamics. And you have geopolitical dynamics as opposed to markets and efficiencies and economics driving a lot of these energy flows and relationships, right? You see the politicization, the weaponization of energy, right? You see, I think, significant government interventions in the energy markets as a result of the Russian invasion of Ukraine and a number of these crises. You see winners and losers, right? You know, the United States has become a very important exporter in terms of supporting our allies, especially in Europe. You see Russia dramatically diminished, I think, over time. The International Energy Agency, right, has said that Russia will be a much diminished energy power over the next decade. And you see in the short term here, maybe for some period of time, real transfers of wealth to the Middle East. The IMF estimates that $1.3 trillion in additional revenues will go into the Gulf oil-producing countries between now and 2026. So I guess the bottom line there is that your lens now, in terms of analysis and investing, and your risk analysis has to take into account geopolitics in ways that you really didn't have to do, I think, during the golden age of globalization.
So, Tom, I'm curious about, I'll call it the rest of the world that you described, not the West, Russia, China, but the rest of the world, and particularly some of the big players, India, Indonesia, Brazil, countries like that. Do we have a sense of whether this geopolitical conflict is bringing them closer to the West or farther away from the West, or are they still deciding?
I think there's competition, right, between over this. Also, I think you also see that the global South and the countries you mentioned are not as deeply involved, if you will, in the Russia-Ukraine situation as the West and the United States are. They've been affected, by the way. They've been affected by the effects on inflation, by the effects on energy prices, specifically, by energy flows, food prices. They've been affected by this, by the dynamics in Europe, but obviously are not as directly involved. And of course, I think what you do see is that these countries trying to trying to manage their way to protect their interests, right, as between these two significant blocks of countries. And you see the competition all over the world right now. And you see it's a competition. It's over economics. It's over values, right? It's over geopolitics. It's over security. And I think it's really kind of come to the fore how expressed this competition is and how these countries, right, kind of outside the core of the West, are having to navigate and kind of protect and seek to advance their interests.
Tom, thank you so very much for revealing this. That's Tom Donilon. He, of course, was National Security Advisor to President Barack Obama. Now he works with Melvini as well as BlackRock. Coming up, we'll wrap up the week with our special contributor, Larry Summers of Harvard. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. We're welcome once again our special contributor, Larry Summers of Harvard. So, Larry, great to have you as always. Let's start with those Fed minutes. We were all waiting for them. They came out. I'm not sure they indicated the Fed is heading in any different direction than what you've been saying.
Those minutes were superseded by history in terms of the strong CPI print, the incredible job market creation, and the retail sales. So I don't think there was anything much informative in them. Look, I think we've got an extremely difficult economy to read. On the one hand, we got a set of very, very strong statistics. I think the data are coming in a way that confirms the view that I have had for a long time, that inflation does not get back to 2% without a meaningful slowdown in economic activity. Yes, inflation may over some intervals come down, but that's really mean reversion from the transitory increases that took place. But that's not enough to bring us to enduring 2%. The other big uncertainty that we have is that while so-called coincident indicators, things that move right along with the economy, look very strong, there are a variety of leading indicators that are more troubling. Inventories look to be building up relative to sales. Firms are reporting concerns about their order books. It looks like the business sector has a lot of people on hand for the level of output they're producing, and consumer savings are being depleted with a low savings rate, and who knows where the market's going to go next.
Lauren, let me ask the scary question. At a time when you and others were concerned about inflation, and Jay Powell was saying, don't worry, if it happens, we have the tools to deal with it. Is it possible the Fed does not have the tools it needs to really get inflation under control, given the circumstances right now?
Look, you can always stop the car by hitting the brakes hard enough, but that doesn't mean you can stop the car without the car skidding and sliding and hitting things. And so, yeah, the Fed can stop inflation, but whether it can stop inflation with a soft landing without impacts on economic activity, that's been very much in doubt from the beginning here since we set off this inflation. And my own sense is that it continues to be very much in doubt. And as the figures have come in, and particularly the figures on non-housing services look to be running way above target level, I think the chances of a soft landing, which look to be getting better, are now receding a bit. What the timing will be, that is hard to know, but we don't have historical examples when unemployment gets below 4 and inflation gets above 4 of getting through the situation without having a recession at some point. And I think that's a powerful historical truth, and I think it's one that's relevant to our current situation.
Larry, this week, as you know, marks 1 year now since the beginning of the war in Ukraine when Russia invaded. Obviously, there's been horrific costs in terms of lives and also in terms of the damage done to the Ukrainian economy. But what about globally? What have been the global economic effects from your perspective of this conflict?
It's been devastating for poor people in poor countries around the world that have had to deal with food price hikes on a very substantial scale, that have had to deal for some interval with higher energy prices. It's accelerated the concerns about the fracturing of the global economy, and that will ultimately, whatever its impacts on us, I think have some substantially adverse impacts for poor countries where historically exports have been a major route to economic growth. Look, I think the world's going to have to step up in the international economic area. We're going to have to spend a lot ultimately supporting the Ukrainian economy and reconstructing the Ukrainian economy. We've got substantial increases for that reason and for others of refugees, but that doesn't make the question of climate, that doesn't make the question of preventing the next pandemic, that doesn't make the question of poverty, it doesn't make what's happening in the Sahel any less urgent. And so this is a time when we're going to need a lot of imagination, a lot of energy from global policymakers.
Well, when you talk about the world stepping up, one of the institutions we traditionally look to is the World Bank. We received word on Friday that President Biden will nominate Ajay Banga. He's the former MasterCard CEO to the position. What do you think about that? And I guess as important, what stands in front of Mr. Banga if in fact he becomes the head of the World Bank?
Ajay Banga was seen as a visionary and highly successful leader of MasterCard, which was unique or substantial in its global vision and in its commitment to inclusion of a very wide range of people in financial services. Of course, the World Bank is a very different kind of institution than any other bank, having global development as its central mission. And it's going to need transformation of a kind it has not seen probably since Robert McNamara was its leader more than 40 years ago. So I think that Ajay Banga has a huge opportunity ahead of him to bring about transformation, but in a world where his shareholders have really serious political challenges at home, it is not going to be easy.
And finally, Larry, let's revisit Israel, something you raised on this program earlier. You saw ahead some possible risks, not just for the politics in Israel of Bibi Netanyahu's aggressive pursuit of reform in the judiciary, but also some possible effects to the economy, particularly the tech sector. We're now seeing it even with respect to the shekel. What is going on in Israel now? And from your perspective, is it getting better? Is it getting worse? Where is it?
I'm very concerned. The first reading of the judicial reform passed through the Knesset. That was very troubling legislation, not because ultimately judicial reform is important in Israel, in my view, but that particular set of judicial reforms driven through by a narrow majority
in a hurry at a fragile political moment will raise profound questions for the owners and deployers of capital, both in Israel and around the world. And I think it is a matter of very substantial economic importance for the remarkable economic story that Israel has been, that we move from a phase of driven legislation to a phase of compromise and deliberation as judicial reform moves forward.
Okay, Larry, thank you so very much for being here. That's Larry Summers of Harvard, our very special contributor here on Wall Street Week. Coming up, forget the NFL. The big banks go for the real money in sports, English football clubs. That's next on Wall Street Week on Bloomberg. Finally, one more thought. You can't keep a good bank down. Major U.S. banks have had their ups and downs in recent years, from the near disaster of the great financial crisis.
At Morgan Stanley, when we were having a hard time, it's my responsibility. I'll take that.
To the major bank revival in the wake of the pandemic.
We're back. In other words, the activity levels and what goes on day to day is bigger than it was before the pandemic.
Recently, things have been getting a bit tougher again for the banks, with trading down.
You are watching Goldman Sachs come down to earth quite a bit.
Provisions for credit card losses rising, and concerns over an economic downturn.
But American consumers, eventually the excess money they have is running out. That'll probably happen sometime mid-year next year.
All of which has led the banks to start trimming their sales through job cuts and reduced compensation.
Bank of America is now joining the ranks of many of its peers in considering job cuts.
But now the major U.S. banks have found a new land of plenty across the Atlantic Ocean in the high-flying world of European football. Please don't call it soccer.
I own my own soccer team. I know.
You just said the word soccer.
Did not.
As the big banks step up big time to help fund astronomical prices for football clubs.
The Premier League's back.
With English Premier League's Chelsea setting a world record for a sports franchise, $5.2 billion, in a deal banked by Goldman Sachs and Deutsche Bank.
It's a Chelsea thing.
Not to be outdone, arguably the most successful of the English clubs, Manchester United, is up for bids, which are expected to shatter the Chelsea record and quite possibly top $8 billion.
Bear in mind, this stock was trading at around $4 billion in terms of market cap, so it would be a 50% premium.
The bids came in at the end of last week, with a Qatari consortium relying on Bank of America and rival bidder, British billionaire Jim Ratcliffe, turning to Goldman Sachs.
Welcome to the Republic of Liverpool.
And if that isn't enough, Liverpool FC is waiting in the wings for a possible sale, working with, yes, Goldman Sachs and Morgan Stanley.
Premier League TV revenues are so much higher than anywhere else in the world.
So when we take a look at the big banks' trading revenues, maybe we should break out what they're making on trading football clubs over in England, though the stuffy banker of yesterday might think it all just a bit silly.
Sentimental hogwash.
That's it for this edition of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.